what this means for everyone moving forward. So this is kind of a big change. There's some positives, there's some negatives, but it's not just going to affect buyers, it's going to affect sellers as well. So kind of going through that, let's talk about why these changes happen. So on March 18th of this year, Fannie Mae issued a lender letter 26-3. This is the most significant update to condo financing rules in years, and it's driven by the post-Surfside concerns about underfunded reserves, deferred maintenance, and financial sustainability across condo communities nationwide. These rules will affect how every condo deal gets financed going forward. So it's pretty clear, Fannie Mae, Freddie Mac have made a variety of changes since that condo incident down in Florida several years ago. And it's pretty clear that they're trying to prevent the risk of something additional happening, to units that they are financing. And so, this memorandum, this letter, kind of outlining the changes is in response to that, and it's part of their drive to try to make sure that condos are safe and maintained and habitable and all the good things. Just a couple statistics here. So 40% of condo project reviews were limited review before this change. And I'll talk about limited versus full review in a few moments. 10 to 15% reserve change. That's going to be huge. We'll talk about that more in depth. And there's 42% of HOA boards have no idea if their buildings are conventional financing eligible. And to be honest, I'm not that surprised by that statistics. Most of the HOA boards are not well run, as I think a lot of us have experienced in the past. So a lot of them don't know what lending requirements there are, so on and so forth. So one of the biggest changes, this is the highlight change, I think, that I saw when I first got the blurb that, I immediately kind of flagged as something to discuss with folks, was the limited review is being retired. So what does this mean? What is a limited review? What is a full review? So on and so forth. The limited review is a much shorter form version of a condo review. So a lot of times this will exclude budget concerns. This will exclude looking at occupancy of the concentration of occupancy within a building. There's a number of things that are not checked on a limited review that a full review does check for. Now, unfortunately, the limited review is going to be no more. So we will not see that past the summer moving forward, or past the end of this year, I should say, moving forward. What we will see is what we've always had, which is a full review. So for those who have gone through the buyer process before with condos, if you had a buyer that put less than 10% down, chances are they did a full review, that lending institution, right? It's pretty rare to see that with less than 10% as far as a down payment. So you've probably already been through this process without ever knowing it. But a full review is going to be more comprehensive. It's going to ask more questions. It is going to look at the full budget, so on and so forth. So what this means for your buyers, what it means for your sellers, is there's more projects that could come under scrutiny that maybe don't qualify anymore for conventional home financing. And I did see a question from Susan in the chat here, so I'll go ahead and address it while we're talking. There's no changes here that are going to affect townhomes. So townhomes are not being addressed in this blurb. So, the townhomes still see a lot of benefits of not being classified as condos. And so all of the stuff today is just going to be explicitly focusing on condos. So the reserve requirements is change number 2 that I noticed as something that would be potentially very harmful for sellers and buyers, because there's just a lot of condo communities that run pretty lean. The budget requirement previously was 10%. Now it's moving to 15%. This kicks in January 4th of next year. So there's a lot of time for, communities to get together, do meetings, and decide what they need to do to get their budgets in a way that will be sustainable for these new requirements. So January 4th, 2027 is when that kicks in. There is an exception to this 10 to 15% rule, and it's when there is a reserve study. So a reserve study is a professional study that's done. It basically outlines what is specifically necessary by a licensed independent professional to maintain the budget of the community and keep up with all of its financial needs. Now, part of this reserve study has also changed. Previously, you could do what's called a baseline study. So baseline is where, the reserve says you need 60 to 70,000, to maintain the budget adequately. You could instead just focus on 60 and not the higher number, right? But now you have to go with the highest number. So that's one of the other little changes. Um, any project that does not meet the 15% threshold could lose warrantable status. So there's a buzzword in the lending community called warrantable condos. Warrantable condos is just another way of saying that it can be financed by Fannie Mae, Freddie Mac. Okay, so insurance rules have also been changed. Now, this is a positive. I don't necessarily look at this as a negative change. So there's a very controversial policy back in 2024 that required full replacement cost coverage on all roofs. We are now going to actual cash value coverage on roofs, and this may not have popped up in a lot of people's purchasing or selling. Roofs are one of those things that only comes up every so often, right? But when it does come up, it's a very tricky situation. And the previous policy, required very expensive insurances to be maintained by condo projects. And what the actual cash value will do is allow for more affordable policies. So, most of these communities are already going to have actual cash value policies in play. So they're going to be unaffected, but the ones that have updated their policies to go to the full replacement cost coverage, they can now take a little bit of a step back to hopefully decrease their dues. Now, I just saw that Claudette is having a hard time hearing with an echo. Is anyone else hearing that on your side?
No, I'm not.
Okay. Claudette, if you want to hop out and hop back in, I'll let you back in just in case that can clear that up. Another important update is that there's a deductible cap for insurance of 50K per unit. This is neither good nor bad. It's just an update nevertheless. And then just something to note for anyone who has clients that, their lender comes back and says, hey, we need you to get an additional insurance policy in addition to the master policy. There's usually a good reason for this, and it's because there's something within the master policy that doesn't cover enough of the unit for the project or the home to be fully financeable by Fannie Mae, Freddie Mac. This is nothing new. This is something that's always taken place. So it's not something that has changed per se, but it's just something to note that occasionally this happens, and there's plenty of good insurance reps out there that can give the minimal coverage to compensate for the whatever gap there is from the master policy to the personal HO6 policy. Okay, one of the really awesome changes that we did see for anyone that's ever tried to finance or get a buyer or seller through a small boutique projects is that we have a waiver now that we don't even need to do a condo review for projects that are 10 units or less. Previously, that was down to 4 or less units. So this is increased by 6. And I would say that I foresee this being a huge benefit, moving the next decade, because I just think there's a lot of smaller groups, a grouping of projects that are being put up that are not, more than 10 units. And, they're going to be able to benefit massively from just not being scrutinized. And some of the things that can pop up with the smaller units is you can just have a less of a reserve, right? You just don't have there's not enough units to give you a big budget, for reserves. And, that could by default make the project unwarrantable. So having this waiver is going to be super awesome. Another thing is the investor concentration limit. I'm sure for any of us that have been in this business for more than a couple of years, you've probably come across an investor concentration issue on a condo before. What that means for those that don't know is if you have too many investors in a project, it can make the whole project itself unwarrantable, meaning that Fannie Mae, Freddie Mac aren't going to finance it. And it's super frustrating for buyers because, of course, if they're buying a condo, it's because they need something that's a little bit more affordable, or something that's close to uptown or so on and so forth, right? And they can't buy with traditional financing because there's just too many people that are currently renting their units. Now, there's a lot of HOAs that have done a really good job of maintaining some restrictions on this just so they could keep, their projects, with the ability to sell. and whatnot. But this is a policy that is now moving forward. That we won't have this, so this is going to be something that's really awesome. Now, I know most of us are not in Florida, but they have retired the PERS requirement. So anyone in Florida that knows what that is no longer going to be part of the process. So that's a positive change for sure. Okay, so non-warrantable condos. So what happens if, even despite all of the changes that we've talked about, the positive, the negative, what if despite that you still find yourself, selling or buying into a project for a client that is not warrantable? What is your options? Well, non-warrantable deals have always been around. And so what that means is, we do what's called non-QM financing, where we can look at maybe a different set of guidelines to, get a property approved. This typically comes with higher down payments, sometimes more interest rates. And so it's not always ideal for the buyer, but it doesn't necessarily mean they cannot purchase in a community. A very good example of where you're still going to need non-warrantable condos. None of the changes that were announced benefited projects that have heavy commercial concentration. So, for your condo buildings that are on top of nothing but retail space, those are still going to be really hard to finance. And so your non-warrantable financing options are typically going to be the only way through. And so you still have this avenue of non-warrantable financing. It's not a deal killer. It doesn't mean your client's getting a bad deal. It just means they have to go through maybe a little bit more hoopla to get into the project. For sellers that know that their building's not going to be warrantable for whatever reason it may be, it's probably a good idea when you're listing as an agent that you put that in a disclaimer so that you can kind of weed out a lot of unqualified buyers. These non-warrantable loans they're not kosher usually for buyers that don't have a lot of money, because they typically require more than 10% down payment. And so you don't want to accept deals where someone's not going to be qualified and just ultimately going to end up kind of wasting everyone's time. So something to keep an eye out for. Not every HOA is going to know. And my experience in the past, that's sometimes a risk for you all to disclose. So again, talk to your offices respectively about it. But if it's a good idea to communicate on either side, at least some level of information on that. All right, so here's our deadlines. So the insurance and investor concentration have already started. So that's March 18th of this year. July 1st, we have the master policy deductible cap at 15K and the HO6 requirement clarified. Again, that didn't really change. It was just clarified more or less, so not really a change there. August 3rd is going to be the first of the big changes. This is where we have the limited review retired. So apologies for saying that was at the end of the year. And then January 4th, this is going to be the biggest of biggest changes. And this is absolutely going to be the one that's going to kill the most deals. This is going to be the reserve funding increases from 10 to 15%. So we've got a decent amount of time to prep sellers and buyers, for getting into projects. It should be noted that if your client gets into a project now with current guidelines and current regulations, that doesn't necessarily mean when they go to sell, it'll be as simple for the next buyer. So when you're advising them on condo versus non-condo, I know that's always a difficult discussion, but these are things that they need to know because, of course, when they go to sell, they don't want to be stuck with something that's not able to be sold per se. One thing I would like to suggest, for you all is the condos, they've always needed a little bit more time. You never want to be too aggressive, on condos as far as time is concerned, but try to give your buyers as much time as possible. So 30 days, I wouldn't push it anything less. If you can get more is helpful. I think we've all known how difficult it is to get condo approvals done, specifically because of the communication with the HOAs. Another thing is to ask about reserves before showing. There is likely going to be a lot of conversations from real estate firms as far as how to handle this. So I would default to that information moving forward. But if someone's willing to let you know what the reserve situation is, then I would, by all means, try to take that into consideration for your buyers and your sellers. If you're working with me, you can loop me in on your condo offers. There's a chance that buildings are already approved. The approvals will have a timeline on them, and we can finance them, based on that approval timeline. Just so I work with Guaranteed Rate. Guaranteed Rate's one of the top lenders in the country. We approve a lot of condos, and so we have a lot of approvals that are in our database. And for as long as those will last, we will use them. And then remember, the 50% investor cap is gone. So that's a really awesome one. But I want to open the floor to any questions that you all have. I know that was kind of a lot of information, some of which you probably knew, some of which you didn't. But who here has any questions about what we discussed today? All right, I see Susan. I saw the condo conversion complexities that converted from apartments at that time. They were not warrantable. B of A did the financing. Yeah, Susan. So, when I was mentioning, there's a lot of alternate and financing arms that lenders have access to. B of A, just like us, they have access to some portfolio products that will finance, certain types of projects. We're always keen to help clients. So if there's an avenue that we can do so, I'll definitely find a way. I'm not scared of condos. I know a lot of lenders will say, oh no, if you say you got a condo coming, they'll be scared because they know what that entails. But, condos are just a little bit more paperwork and a lot of education with clients up front. I always prep my clients in the beginning of the plan A, plan B. So plan A is just everything goes hunky dory and the project meets perfect financing guidelines, et cetera. Plan B is it may not. And so this is what plan B would look like. I think that's a good recipe to have for clients, because if they kind of know what to expect and they know that it might have a few bumps in the road and there's stuff that we may not be aware of before we dive into the process of going under contract, it makes that conversation a lot less tricky if we have that plan B kind of ironed out up front. That is the downside, though, with condos, is we don't always know. I mean, you can ask questions of the listing agent, or if you are the listing agent, you can ask questions of the HOA. But until that condo questionnaire is completed, there may be new information, or there may be something else that's hiding behind the scenes. And so it's always kind of a hard one to move forward with, because you don't have the ability to tell your client with more certainty, of everything like you do with maybe townhomes or single family. But good example, Susan.
Can you hear me?
I can hear you now. Yeah.
Okay, sorry. I was just thinking of the percentage. It's gone to 15%.
Yes.
15%, at least 15% of reserves, or 15% of whatever. How do they determine? Is it the total amount of money that's in some, I guess, a bank account for a condo complex, 15% of what's in there? Is that how they figure that?
So it's going to be 15% of the annual operating budget. So that's a lot to ask of associations to kind of keep in the piggy bank, but that's how the calculation's being done. They're not requiring it to be in one specific account. It just needs to be under the condo's control.
So you said in the operating budget. So they'll have other money that's not in the operating budget, is what you're saying. And they have to move that into a specific category.
Correct. A reserve category. I mean, every HOA should already have a reserve budget as a whole.
Mm-hmm.
And you see this with townhomes too, right? For the master HOA. So they should already have that within the budget. They should have a separate section of that for allocation to reserves. This is just increased it by a whole 5%.
By a 5%. I hear you.
Yeah.
Talk about townhomes as opposed to condos. Have any of the lending institutions, are they going to pull townhomes into this category as well?
I can't speak for individual institutions. I can speak for mine, and I can speak for Fannie Mae, Freddie Mac, because that's the guidance that we're taking from this and why we're having the conversation today. Fannie Mae and Freddie Mac have not expressed any interest in changing how condo or how townhomes are run as of yet. I cannot promise that that won't change at some point, but so far they have skirted around a lot of the restrictions and additional policies that condos have had. And they're more similarly viewed as single family homes with a few nuances, like having a master HOA that maintains exterior coverages and things of that nature. So far, to answer your question, no changes on the townhome front from Fannie Mae, Freddie Mac, and my company specifically will not be having any overlays added to them. But I cannot comment for others.
Okay.
Good question. Now I know we have 10 more people in this room. Does anyone else have any questions, or am I just too good at explaining things? I don't think that's the case. You're welcome, Marwa.
Um, yes, I will ask another question.
Of
So
course.
your company will be happy to pull up information on a condominium complex and determine if it is Fannie Mae, I guess, or FHA even, Fannie Mae or FHA approved before we make an offer on it.
We do. So we have an internal database that we maintain of any condo that our company has approved. So just for reference, conventional financing, that database is maintained internally amongst lenders. So there's no external database like you have with VA or HUD for your FHA loans, where you can view that on a like a website publicly. So we maintain our own internal database. Rate is a massive company, top 10 lenders. So there's a lot of condos that we've approved. And so if they are in our database and the approval is current, then we can move forward with that on a limited basis of what we specifically need at that time. If the building does not have a current approval, then we still have to go through, the full condo review process like was outlined today. So those approvals, they don't last forever, and it's based on recent approvals that were done. So if there just hasn't been one done, then the building's not going to have an approval that you can rely on. But we do look at that, we screen that, and if we have it, that's obviously helpful because it can drastically reduce the worry on the process as well as the length of time to do the loan, and everyone can have a little bit more assurances.
And you said you can check for FHA loan
Mhm.
approval as well, correct?
Yep, FHA and VA.
And VA for
Mhm.
condos. So I don't know if they're a lot more stricter than this conventional financing now or not.
I think with the changes on the conventional side, especially with the budget, I think we're starting to have some equilibrium. Historically, FHA and VA have been harder, on the communities than conventional financing. And they're harder in their own way. I mean, I think we've all dealt with FHA and VA difficulties on just standard transactions, appraisal specifically, with a little bit more fine-tooth comb view of everything. But with these changes on the negative side, with the budget reserves, et cetera, for the conventional financing, is definitely more in line. There's going to still be nuances between the different programs. But again, going back to your question, we'll look at the approvals and see which ones are there. If there is an FHA one, then that can always be something that's held in the back pocket. If your client prefers to go conventional, obviously that's the way we would want to proceed, but you can always kind of hold those approvals in the back pocket if there happens to be one for FHA, just to have it for some assurances. It's pretty rare that you'll have one that's approved FHA that won't be conventional, but I don't want to rule out anything. But yeah, good question. Anyone else? Claudette, you have any questions? Maria, any questions? Chelsea? Melissa?
No, I'm good
Vanessa?
right now. Thank you.
Of course.
I'm good, thank you.
Perfect. Well, if no one else has any questions, then I am going to turn over this time back to you all. I appreciate you all again jumping on the call today. As more information comes out, as far as how these scenarios will directly affect everyone more specifically, I'll be sure to update everybody. But for now, this is the general overview of it all. And if you have any questions, this is all my contact details. You can, reach me on Instagram if you're a DMer. You can go to my link tree and get all my contact details, email me directly. And then I do these calls every Tuesday at noon. Today was talking about condos. Next week, I'm going to talk about some AI implementations, things of that nature. I try to bring something fresh every time, and I want these meetings to be interactive. So, usually there's some good dialogue and whatnot. That's part of that. So it's always cool if you have a few moments. And I don't require registration, so you can always just drop in if you want to for a few minutes, so on and so forth. But with all that said, again, I appreciate everybody. I hope you all have a great rest of your Tuesday, and we'll talk soon.
Have a good day. Thank you.
Have a good one. Thank you.
Thank you.